Hello, friends. Welcome back to another episode of the Kuderna podcast. I'm your host, Bryan Kuderna. So, as you probably already know, oftentimes we'll toggle back and forth from having guests here on the show to every once in a blue moon, I put on my professional hat as a CFP to give you a monologue on some timely topics dealing with investing, personal finance, or economics. And that's exactly what we're going to do in today's episode. So earlier this week, I wrote my halftime report, which is a letter that goes out every 6 months to my clients, covering all the things that are important to their money. And I thought it would be a great opportunity to share that, kind of summarize it here in a video and audio format for all of you as well. Because like I say, knowledge is power. You've got to know what's going on. You got to be able to cut through the noise. And that's how you can make smart financial decisions, which is ultimately what we're all after. So as always, chaos breeds opportunity. And the first 6 months of 2026 certainly brought about a lot of that. I know every night you could turn on the news or you could log in on your phone and just kind of see headlines that will either make you very excited, they might make you terrified. It's just coming at us all so fast from every which angle, and everybody's got an opinion. And you've probably heard me say this 1,000 times. One of my mantras is that an emotional investor is a bad investor, arguably the worst investor. Sure, there's times where you could hop on a bandwagon or maybe panic and you get lucky. You might have a gain or prevent a loss in the near term, but long-term wealth building and financial planning is built on a process and acting rationally. And that means taking the emotion out of things. So that's what I want to give you today is the hard facts on what the first 6 months of 2026 brought us so that you can have a good idea of what exactly happened. Again, cutting out the spin and the noise and looking forward to the second half of the year with some ideas of what to expect and what the playing field looks like.
Is going to require work and time and sweat and toil.
If money wasn't an issue, what would I be doing?
Don't worry about it. You'll figure it out.
Change is the only constant.
The Kuderna Podcast.
So let's kick it off with the stock market. How are we doing so far in 2026? So I'll give you some numbers here that I'm going to rattle off. You might want to rewind or re-listen at times to this, and that's okay. But I want to give a refresher as to the overall stock market as a gauge by the S&P 500. Again, that's the index tracking the 500 biggest companies in America. It's actually a little bit more than that, but we'll just refer to it as the 500 biggest, and a good gauge of the overall economy and stock market. So the past 5 calendar years have been pretty exciting. 2020, again, that was the year of COVID. The S&P 500 was positive 18%. 2021, all right, about a year after COVID came about, we were positive 28% in the S&P 500. Those are 2 really good years, guys. And then 2022, this was a bit of a wake-up call, negative 19%. And then 2023, big rebound, positive 26, 24, positive 25%, 2025, positive 17%. So just one down year out of the past 5. And those 4 positive years were very positive. You could see there either in the high teens or even in the 20s, the returns that we've witnessed. So you'll hear all different quotes on like, what's the average annual return of the stock market? Depending on the period of time, remember everybody witnesses their own kind of snapshot in time that they're in the markets. But a lot of studies that you read will range anywhere from 7 or 8% to some even approaching 10%. So naturally, we've been exceeding that by quite a bit over the past 5 years. That's led a lot of people to wonder coming into 2026, what are we in store for? Is it going to be another banner year, or could it be a 2022 where we have a wake-up call? So I'll give you, again, the cold, hard facts on the stock market. Year to date, the S&P 500 is positive 10%. All right, so kind of trending in a similar, very upward trajectory as we've gotten used to in the recent term or recent memory. The Dow Jones Industrial Average is positive 11%, so moving very closely with the S&P. The NASDAQ, which is really representative of the tech sector, is also up plus 11. So you could see the major indices right there are all moving almost in track with each other, at least through the first 6 months. The MSCI EAFE, which is a good measure of international stocks, okay, so outside the US, that is also plus 11. So no outliers yet. If you just said, I'm covering the total stock market, you're looking right there around a 10 or 11% return. But as we dive a little bit deeper, let's take a look at the Russell 2000. All right, that's representative of small cap stocks. That's positive 21. That's a clear outperformer so far this year. What about gold? Gold has been on an absolute tear in recent memory leading up to 2026. However, year to date, it is now down -4. Real estate is about flat on the year, give or take, a fraction of a percent. The 10-year treasury, okay, so giving us a gauge of overall interest rates, is sitting at 4.49%. In Bitcoin, all right, for the crypto fans out there, Bitcoin is down -28% year to date. Okay, all of those figures are at the halftime. So coming into July 6th of 2026, that data is courtesy of Yahoo Finance. If we want to look a little bit further, what is leading the way here? What are the real gainers? What are the losers so far in the year? It's no surprise, year to date, the biggest winners in the S&P 500 are all chip related. Okay, we've heard plenty about AI, and there are winners and losers in AI right now. But the biggest winners right now, you have SanDisk, which is up 545% year to date. We have Micron up 251%, and Intel, which is up 236%. Okay. The worst performing large cap stocks of the year, just a few to rattle off here, are Intuit, down 59%, CoStar, down 56%, and Boston Scientific, which is down 53%. Right, those are your real laggards inside the S&P 500. So as you can tell here, the investment performance has really been a tug of war between AI-related capital expenditures, which have just been astronomical, and corporate earnings, which have also been pretty strong. So that's the positive influence. But then on the other side, we have some of the geopolitical and economic factors, in particular, inflation, tariffs, and then interest rate uncertainty that is kind of pulling, or I should say maybe pushing against some of the AI and the earnings reports that we've been hearing about. And if you're saying, well, what are those capital expenditures? Like, where is all of that AI money coming from that boosted those three stocks I mentioned at the outset? Well, if we look at, some of the Magnificent Seven, some of the tech sector, in particular, Amazon, Alphabet, better known as Google, Meta, better known as Facebook, and Microsoft have all invested over $100 billion in AI and data center development. All right. Some of those approaching $200 billion of capital expenditures. So you got to remember, when you talk about AI, artificial intelligence, that entire stack, as they like to call it, is investable. All right. You could think of, we have the raw materials at the very bottom. That's the copper, the uranium, the rare earths that are used inside of these microchips, inside of our phones, our cars, our computers, and things. Then you have, kind of moving up, you have the different cooling companies, the chip makers like the NVIDIAs and such, all the way up to the mega cap hyperscalers that I just mentioned, like Microsoft, Google, Amazon, etc. So the money is kind of flowing from the top all the way down. And that's where you're seeing kind of the bottom of that totem pole, or the bottom of that stack, has had massive boosts to their revenue. And then the hope, or the theory, is that that is going to start to matriculate its way back upwards. And we'll see the Amazons, the Microsofts, and the like start to really reap the rewards of their investments. Again, that is the hope. Right? We've seen their revenues go down as they're making these massive investments and buying all of this product, trying to get more compute. And now we have to see if it's actually going to pay off and work its way back up. Okay. So something to keep in mind as you're talking about AI, there's so many different facets to it. It's not like there's just obviously one or two companies. Granted, that's often what we hear about in the news. So you might notice over the past 5 years, The only negative that I had mentioned was 2022. And just you might be saying, man, that seems like a lifetime ago. So much has happened between now and back then. So the reason 2022 was down so much, that's when inflation reared its ugly head. We saw the worst inflation that we had seen in over 4 decades. And again, as a reaction to that, the Federal Reserve hiked interest rates high and rapidly. They were very, very aggressive with that. And as I'm going to get into in a moment, that's really what shocked the stock market. Okay. So I just talked about all these great things going on from AI, at least from a financial standpoint. But remember, on that tug of war on the other side is really the economics of it all. And we're going to talk about if that's going to have an impact in the second half of 2026. So I've done plenty of episodes on the Fed, kind of how money works throughout our economy. If you want to go back and just look at some prior episodes, again, where I do these monologues, please do so. I've taken a deeper dive on how the Fed works. But in short, if you haven't listened or watched those episodes, the US Federal Reserve is arguably the most important financial institution in the world. Okay. A lot of people point to the White House, they point to the huge companies, the tech sector, all the impacts that could be had there. But arguably, the controller of it all, of all of this money, is the Fed. And of course, the US is the biggest economy in the world. So our central bank has a monster influence, not just here, but also abroad. So it cuts to interest rates. What exactly does that do when the Fed cuts interest rates? Well, it makes borrowing cheaper. The ability to go out and get a loan, whether it's a massive business making these, capital expenditures, a mom and pop shop trying to open up a new storefront, or maybe you're trying to go buy your first house and get a mortgage, or even go get a new car and get an auto loan. All these things, to your credit cards that you're going to buy dinner on tonight, it's all affected by interest rates, again, which the Fed kind of controls all of that. So when they cut interest rates, borrowing becomes cheaper. It expands the money supply. There's more money flowing through the whole economy. And usually that will boost the stock market. All right. Even a whisper of the Fed cutting interest rates could boost the stock market instantaneously. Okay. Now, conversely, on the flip side, if the Fed were to hike interest rates like they did in 2022, it does all of the opposite. It's going to make borrowing more expensive. It contracts the money supply, and then that will usually depress the stock market. Again, just a whisper of the Fed hiking interest rates that can spook investors across the entire landscape and really hit the stock market hard. Okay. When do we cut or when do we hike interest rates? Or I should say, when does the Fed do that? Well, the Fed cut interest rates 3 times in 2025. That, along with all the AI stuff I had mentioned, there was a lot of factors there to really prop up the stock market last year. So far in 2026, the Fed has chosen to keep rates steady. They have not hiked them, but they have not cut them. All right. The federal funds target range is still 3.50% to 3.75. Now, remember, the Fed has a dual mandate. They have 2 things that they're ultimately responsible for. Number one is moderating inflation. Okay. Remember, they have a target rate of inflation of 2%. That is their target. And they have been very clear. They do not want to waver from that target. In addition, they have to monitor unemployment. We want a strong economy, strong employment numbers. Those are the 2 things that the Fed looks at. And everybody always argues, hey, is the Fed proactive? Are they doing enough? Well, ultimately, the Fed is data dependent. And by virtue of being data dependent, they are forced to react to what is going on in the economy. So let me give you some numbers that are going to influence those decisions one way or the other. So inflation, where are we at right now? As measured, by the Consumer Price Index, or the CPI, inflation has increased 4.2% over the past 12 months. 4.2%. Remember, the target is 2. That means inflation currently is trending about double what the Fed would like to see. Now, most of that increase is directly a result of the increased energy costs since the war in Iran. And we can do a whole nother episode on that. Maybe we'll have some experts to talk about geopolitics. I know I've had them on the show. But the war in Iran, I think what we've seen so far is it's been resolved. restarted, resolved, restarted about 100 times since we started the war. Or you could just argue that the war has been going on steadily from the get-go, and we're just hearing noise and opinions one way or the other that we want it to start or we want it to end. And it's, I won't comment too much on that. But I think if, again, this history is kind of any precedent of what's going to happen moving forward, we should continue to expect volatility there. As I'm recording this, right now, I know that Iran just attacked 3 more vessels that were going through the Strait of Hormuz. The U.S. retaliated with more airstrikes. This is just more of the same that we've been seeing. So hopefully it does get resolved immediately. That would be awesome. But I don't foresee that. I don't think that that's realistic. That's my opinion. And again, that's just going off of what we hear and see every day. Doesn't take a rocket scientist to kind of read the writing on the wall. So I would expect some more volatility, energy costs to remain somewhat elevated. Hopefully they don't spike like they did at the outset, but I don't see them falling for any particular reason in the near future. What does that mean? That means inflation may not increase further. We might not see higher numbers, but I don't really see a reason for it to come down. As a result, the Fed is either going to hold interest rates steady like they've done, or if they want to get hawkish, they want to get bold, they may even do a rate increase, which again, that would be a negative when it comes to stock market performance. Okay, so we're going to have to wait and see there in respect to inflation, what the Fed decides to do. Kind of a sidebar to that, I'm sure many of you have seen or heard that President Trump was kind of bashing, for lack of a better term, the prior Fed Reserve Chairman, Jerome Powell, constantly demanding that he cut interest rates, that we needed that for our national debt, for housing costs, to boost the economy and so forth. But he was reluctant to do so, the Fed chair. And the reason being is that that would then prop up more inflation, which is what they're tasked with avoiding. So we have the new Fed chairman in there right now, Kevin Warsh, and I know the president was hoping that he would be more apt to cut interest rates. But in his first federal meeting, the FOMC unanimously held interest rates steady, and he spoke quite hawkishly about inflation. So again, I don't foresee cuts, at least in the near term. Again, my opinion based on the data that I've seen. Unemployment, the other part of their dual mandate. Unemployment remains relatively low at 4.2%. Okay. However, June's jobs report showed a softening with only 57,000 jobs added versus an initial estimate of 113,000. So what does that mean for unemployment? Hopefully it remains there, but we could see some adjustments to that. That has not been as big a factor. I think what the Fed has been laser focused on, of course, is inflation. So what does that all mean for the US and for the world? Well, let's take a quick look, a recap of the global economy. So US GDP, or gross domestic product, was higher than expected in the first quarter, having increased 2.1% annualized versus expectations of 1. So that was really good. That's a great sign for the economy. That's the first quarter numbers of this year. US GDP is currently $32.4 trillion, still by far the largest in the world. Number 2 is China at $20.9 trillion. For context regarding the ongoing war that I just alluded to a moment ago, and how quickly global economics can be disrupted, and as we're seeing by what we would think of as minor powers or minor issues that have major effects, if we look at Iran's GDP, it is roughly 362 billion with a B, okay? That is about 1/100th of the US economy. Yet Iran holding the Straits of Hormuz kind of hostage at this point. We've seen the effect it's had not just on energy costs and inflation, but Fed decision-making and the overall markets across the globe. So interesting insight there. Now let's pivot. Let's talk a little bit about taxes, okay? So the One Big Beautiful Bill Act into law last year, all right, July 4th, 2025. That preserved the individual income tax rates and brackets that otherwise would have reverted going into this year. All right. The standard deduction for 2026 increased to $32,200 for married couples filing jointly and $16,100 for single filers. The law also raised the SALT deduction cap for the state and local taxes. It expanded certain deductions and credits, and it reinstated the 100% bonus depreciation for many business assets. So a lot of the tax commentary there, I can't find the right word for that, but the tax impact has been a positive one for economics. You could just listen to what I just stated, and all of those are things that are supposed to create larger refunds for Americans and lower costs of doing business. We'll see how that all plays out, but that's another part of that kind of tug of war where I would say that the taxes upheld by Trump was a positive for the stock market. Some more IRS numbers in regards to retirement contribution limits. They moved higher for 2026. This is now allowing employees to contribute up to $24,500 a year into their 401ks, 403bs, thrift savings plans, and the like. The IRA contribution limit also increased up to $7,500, with catch-up amounts being adjusted for those over the age of 50. And then Roth IRA income limits also went up. They are now at 153,000 modified adjusted gross income for single filers and 242,000 for those married filing jointly. Once you equip those income limits, that restricts how much or if any you can contribute to a Roth IRA. Again, I've done many episodes on the Roth. I'd encourage you to go back and listen. I'm a big proponent of tax hedges and allowing for tax-free growth. That can give you much more clarity when you do retire and allow you to practice tax arbitrage. So there are things that you should be aware of. And just another caveat as I'm talking about the Roths, I always have to remind people, if you have a Roth option on your workplace retirement plan, like your 401k, those income limits do not apply. Now, if you say, well, I want to do a Roth IRA, but I'm over those limits, you can still do the backdoor Roth IRA. That's still a thing. I've done episodes on that you can also listen to as well. All right, so that's a little bit about the stock market, the economics, the tax climate, and then I'm going to wrap it up with insurance. So anybody that's following my financial planning or advice knows that I follow a 4-step plan, and the first step is protection first. So I want to clue in a little bit of what the insurance marketplace looks like as well. And we'll start with life insurance. So 2025 was a record year for the life insurance industry. Annualized premium was up 10% with over $17.5 billion of new premium. All right. And we're kind of moving in the same direction so far in 26. Total U.S. individual life insurance premium was up $4.5 billion for the first quarter. And whole life has remained the largest product line, which it has just about every single quarter the stat has been measured. Whole life represents 36% of all new life insurance premiums. That is followed by indexed universal life, term life insurance, and lastly, variable universal life. What about annuities becoming so popular in the retirement planning landscape? Total U.S. annuity sales were over $107 billion in the first quarter of 2026. That's up from the prior year and has continued a streak of $100+ billion quarters. Fixed rate deferred annuities have remained a significant player in that. Okay, again, that's tied directly to interest rates, that 10-year treasury I mentioned at the outset. Although some of their sales have declined as clients and investors look more towards what are called RILAs, or registered index-linked annuities. Those are commonly referred to in the media as buffer annuities, and other products that can give clients or investors both upside potential with some downside protection. What about disability insurance? I talk with my clients all day long about income protection. A financial plan goes nowhere without the income being protected. So individual disability insurance, the latest market surveys show new sales premium of $491 million in 2025. That was up slightly from 2024. And medical occupations, those being doctors, dentists, veterinarians, they account for over half of the $5.6 billion of total in-force premium currently. That should come as no surprise. They understand people get sick, people get injured, and also they have some nuance to their occupations using their hands, physical duties, fine motor skills, and the like. The GSI, or Guaranteed Standard Issue Marketplace, which is a huge emphasis of my practice with teaching hospitals across the country, was especially strong. New GSI sales premium increased almost 31% to $105 million. All right. So this was the latest and greatest. I know I shared a lot of data. For some of you, your eyes might be rolling right now, or you might have to go rewind and play it a little slower. I apologize if I spoke too fast at any point, but knowledge is in power, and we need to have the facts to understand what is going on. All right. So I hope that those numbers, those figures I was sharing, give you some insights as to what it means to you and your money, whether it's getting kids through college, planning your retirement, handling your estate planning, tax management, or protecting it all through these different insurance products. Hopefully that was a good overview of what the landscape looks like. So what does the next 6 months of 2026 bring for us? Time will tell. I do not have the crystal ball, but like I said, if we can draw any pattern from recent history, there's a tug of war going on right now between AI and the massive, massive boost that has given to our economy, and then the offset of inflation, higher energy costs, higher housing costs, and some of those things that are going on, tariffs that we're still contending with. So we're going to have to see, that remember that the stock market, which I know is the foundation of so much of what I just discussed, the stock market is a leading economic indicator. As soon as thoughts, rumors, ideas, or these figures get out there into the universe, the efficient market theory, remember, that's showing that immediately that is reflected in the stock market. Okay. So you have to kind of think about, is a lot of this massive, massive investment in AI, is that already baked into the stock prices that we see for the relevant companies, right? Or is there more to come? Are we just on the precipice of this? But all the while, we can't forget that there's also an economy out there that we have to pay very close mind to. Hopefully we can end this war in Iran. Hopefully energy costs come down. Hopefully inflation comes down. And then hopefully the Fed is able to cut interest rates, making life a little bit easier and cheaper and boosting the stock market further, a win-win for everyone. That would be a utopia. Hopefully we do get there, but I don't know if that's anything that's going to happen in the near term. If I had to crystal ball it and you asked, hey, Bryan Kuderna, Mr. CFP, what do you think? I see interest rates staying exactly where they are. There's so much pressure from the White House to cut interest rates, but absolutely to not hike them. And I think the Fed, which is supposed to be acting independently, may at some point want to hike them if the inflation stays at this current number. So I think the happy compromise would be just staying put. And that's where we're going to have to wait and see if we've already had the rally so far for the year, or if we're only halfway on the runway and this is going to continue to be similar to 4 of the past 5 years that had these monster gains. Time will tell. Last but not least, I want to remind everyone, if you're saying, hey, how can I take all this info and apply it to my own financial plan? Well, of course, you can email or call my firm, but what I'd really encourage you to do is go out and grab my new book, Simply Wealthy, the 4-step plan for financial freedom. It's now available wherever books are sold. It's an easy read. I intentionally made it short and compact and straight to the point so that you can understand what to do and why to do it. So again, that's called Simply Wealthy. Go check it out, and can't wait to see you on the next episode. Be well.
This podcast is intended for the general public and for informational purposes only. The show does not provide any recommendations or investment advice regarding any specific account type, service, strategy, or product, or to otherwise act in any fiduciary or other capacity. Please contact a financial professional for guidance and information that is specific to your situation. Bryan Kuderna does not provide tax or legal advice. Please contact your accountant or legal advisor to discuss your situation. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Kuderna Financial Team, and opinions stated are their own. All investments contain risk and may lose value. Past performance is not a guarantee of future results. References to specific securities, asset classes, and financial markets are for illustrative purposes only and do not constitute a solicitation, offer, or recommendation to purchase or sell a security. Bryan Kuderna is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS. OSJ 300 Broadacres Drive, Suite 175, Bloomfield, New Jersey 07003. Phone number 973-244-4420. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Kuderna Financial Team is not an affiliate or subsidiary of PAS or Guardian. California Insurance License Number 0K04194.